All right, guys, so in this video, we're going to talk about the basics of loans, okay? We're going to talk about principal, interest, the term, and other basics that go along with taking out a loan. All right? The first term there is principal, which is the amount of money you're going to be borrowing from the bank to buy whatever it is you want to buy, okay? If you're going to buy a car, it's $5,000. You're going to borrow the $5,000. That's going to be the principal. The interest is the rate the bank charges for you to use their money. Okay, it's usually a small percentage of the principal. You'll see interest rates of 2%, 5%. In some cases, it goes up to maybe 10 to 20%, depending on what type of loan it is you're taking out. The term is the length of time you have to pay back the loan. Usually in years. Okay, sometimes it could be in months, depending on what it is you're buying. The more you borrow, generally the longer you're going to have to repay. All right, so principal, interest, and term, okay? When it comes to interest rates, you can do one of two things. You can have a fixed rate or a variable rate. So it's very important to understand the difference between these two. A fixed rate is exactly what it says. It's fixed. Over the course of the loan, over the length of the term of the loan, the interest rate is going to stay the same the whole time. All right? Variable rates are a little bit more complicated, okay? You need to be very aware before you sign on to a variable rate loan, okay? They're going to change over time based on whatever market or index rate the bank is using, okay? Now, in this example, I use the prime interest rate, okay? So the bank would tie your loan to the prime interest rate, okay? So sometimes the bank would charge you something in the, as an example, prime plus 2. Okay, so whatever the prime rate is, they're going to add 2% to that. So if the prime rate is 3%, you're going to pay 5%. If it goes up after the first year to 5%, then your interest rate moves up to 7%. And that's where the danger comes in, is you don't know what the rate's going to do. So your payment can change over time. And in some cases, you won't be able to make the payment once the interest rate goes up. Okay? So because of that, fixed rates are generally preferred. But if you understand the market really well, you're able to predict how things are going to move, and you think that interest rates are going to go down in the future, then maybe a variable rate could be advantageous for you. However, the danger is always there that the rate's going to go up and your payment could go up significantly. Okay, so for you guys, I'm suggesting that you use fixed rate loans almost all the time. So just be aware of that difference. It's huge, okay? The security aspect of the loan. So there's two types of security aspects for any loans you might take out. One is secured, and this is really common, but unsecured loans are also very common as well. So understand the difference and understand when each would apply, okay? So a secured loan, the most common are home and car purchases. The borrower has to put down some collateral for the loan, and generally, it's going to be the house that you're buying or the car that you're buying, okay? Other assets like land or jewelry or, investments that you might have can also be used as collateral, okay? Because the loan is secured, the banks are at a lower risk. So because of that, you can expect to have lower interest rates. What happens if you don't make the payments, though? The bank's going to take that collateral and sell it to pay off the loan. That's why the banks are at less risk. If you stop making your house payments, the bank comes in and takes your house. If you stop making your car payments, the bank comes in and takes your car. So that's where the security aspect comes in. Unsecured loan, on the other hand, there is no collateral put down. Okay? Usually we're talking about credit cards. Your student loans, there's no collateral that you have to put down for those. And other personal loans you might take out. Okay? Because there's no collateral down, the banks are at a greater risk. So you can expect those interest rates to be higher, okay? In order to, receive one of these loans, your bank is going to look at you and judge you based on certain criteria or information. One of those is credit score and credit history, okay? And we've already talked about student loans. In some cases, your credit score matters. In some cases, it doesn't, okay? What are the conditions of the loan? That will be something the bank looks at too, to see if you're worthy of receiving that unsecured loan. What is your income? What other assets do you have? Okay, and some other factors. Finally, do you need a cosigner? Okay, let's define what that is first. A cosigner is another individual, usually a family member or a really close friend, who signs on to the loan with you. Now, this is dangerous for them because if you fail to make those payments, they become responsible and they are required then to pay. Okay, it's a very big deal. The cosigner's credit score is affected by your ability to pay the loan. Okay, so you need to be very aware of, the people you're asking. Don't think if they turn you down, it's not necessarily a bad thing. They're just worried about their credit score being affected. Okay, do you need one? Okay, you're going to need a cosigner if you don't meet the qualifications to take out the loan based on your own personal credit history. But again, think long and hard before asking someone, because it really is a big deal. Okay, so that's basics of the loan. There's a lot more that goes into it. We haven't talked about fees, closing costs, etc. But just talking about the basics of a loan, we want to know what the terminology is, secured or unsecured, fixed rate or variable rate, and do you need a cosigner?